June U.S. employment report showing 206,000 jobs were added last month. The unemployment rate now at 4.1%, slightly above estimates. Treasury yields, let's show you where things stand right now. The 10-year note at 4.296, the 2-year at 4.635. Let's show you where equities are, too. Can we actually just flip the board around? I want to talk about what all of this means for the jobs number and what the jobs number can mean for the Fed and therefore what it might mean for equities. I wish we could show that board. There you have it. Everything up except for the S&P, by the way, off still marginally. Joining us is former Fed Vice Chairman Roger Ferguson. He's the former president, of course, and the CEO of TIAA, Vice Chairman of the Business Council and a CNBC contributor. And as I said for a long time, Roger, the one who's called it right. So you read the number. You saw the number. Jay Powell has now seen the number. What do you think of the number, and what do you think the Fed does about the number?
Look, I think the number is on balance, a good number, not a great number. 206,000 is not a sign of an economy that's falling out of bed. They did some adjustments looking backward, obviously. And finally, I also say that the labor force participation rate is also a sign of an economy that's sort of coming back into balance. So if I were looking at this number as a policymaker, I'd say, this is pretty good news. The economy is not falling out of bed. We don't need to rush to cut to deal with that side of the mandate. Let's measure closely on inflation. And I would argue, frankly, September, while the market thinks it's the time to go, I think it's more 50-50. It's also possible to wait for a bit more data to be certain about the inflation continuing to slow. So we've seen signs of slowing, but from a high level. So from my standpoint, good number, not great number, not sure that it's the all clear that we must cut, that the Fed must cut in September.
What percentage would you put on a November rate cut? And of course, we should mention that rate cut would happen after the election.
Obviously, the Fed is very data dependent. So I think as we get further and further in the year, assuming things continue to unfold this way and inflation gets under control, we're going to see a rising likelihood of a cut this year. November might be on the table. Obviously, we would get a lot of political howling on both sides. Consequently, December might be more likely. But it really does depend, very importantly, on how things unfold. And I think we ought to be very clear the Fed is going to try to be as apolitical as possible, look closely at the data, and be prepared to move at any one of the next 3 meetings if that's how they interpret the data.
It still appears that both economists and the market seem to think that September is in the offing. I mean, it also seems that the market's been ahead of itself pretty much the whole time on this.
Well, that's exactly the point I was about to make. Yes, the market, for lots of obvious reasons, would like to see a cut. Frankly, I would like to see a cut too, because that would say inflation is clearly, under control and moving towards that 2% target convincingly. But I would also argue that, as you just pointed out, the market's been a little optimistic about a cut. And I would say this data, 50-50, not to say zero chance, but I think the market, again, might be a little optimistic because I don't see anything here that says the economy is really weak. I see an economy that is either weakening or getting back into better balance more sustainably.
So here's a slightly different question, because we keep talking politics all morning. Obviously, we're in the middle of this election, and there's a big question about whether President Biden stays in the race. Of course, he says he will. But how do you judge this economy today, Roger? And how do you judge this economy between now and November? Because there's sort of one version of judging it on the basis of the way the Fed might judge things, if you will, and maybe the way the market might judge it. And then there's actually the underlying economy itself.
So, look, I think the underlying economy is good. I think it's solid. One might even say strong. These numbers that we're seeing in terms of unemployment at 4%, that's not a sign of a weak economy. And certainly, job growth in the 200,000 or so, roughly every month, is not a sign of a weak economy. I think the challenge, however, is, one, inflation has already done its dirty work. And so people think about price levels, not just the changes. So while central banks say, well, inflation is coming down, average households and certainly low and middle income houses say, but already prices have gone way up. So I think there's a whole cadre of people, and the Fed is aware of it, who feel the economy is not good because they have seen their prices go up more so than their wages. And I think we see the other side of this economy that it's pretty unbalanced. Most of the growth is coming from the top two quartiles or top two quartiles of income, and the bottom are not doing so well. And so I think it is overall a good economy, but one that is uneven, and that I think creates a lot of the dissonance and noise and the ability to talk about the economy one way or the other, depending on where you sit in the income distribution.